Broadcasting live from Houston, from the space city to the world. You are watching Now Media Television.
Welcome back, everybody, to Biz Talk with Sherman. I'm your host from Hotaling Insurance Services. Excited again. Want to thank Tammy and Kyle for coming on the show, talking to us what business owners should be concerned about with some of the different scenarios that they need to plan for. At the same time, what they can be doing and looking at when it comes to some of their individual tax returns. So, really excited to be able to have a tax planning expert on, Ranjit. So, welcome to the show.
Thank you.
So tell me a little bit about your story. Kind of people that might not know who you are, Ranjit.
Sure. Basically, I'm a CPA, and I started my own firm right about in October of 2019. Was right before COVID. Didn't know COVID was going to happen, and then COVID happened, and it just went skyrocketing in business because there was PPP, EDIL. There's so many different scenarios going right now. Right now, there's a lot more retention tax credit, if people don't know about that one.
Okay. And so one of the things that you guys specialize in your role is really tax planning. And so describe what that is for the average human.
Sure. Tax planning is a big course of action. Like, we're not the average CPA firm that just focuses on the individual tax return at the end of the year, or just thinking about, like, it's all about figuring out strategies to reduce your taxes. Because there's majority of companies out there are actually overpaying their taxes. Because there's different ways, right? Are you an S Corp? An S Corp, you'll be able to reduce your self-employment taxes. And how do you do that is a little bit more complicated. They're like, oh, do this. It's like, no.
Yeah.
There's a lot more steps. Then are you a C Corp? What are you in the right structure? Partnership, solo prop. There's so many different scenarios, and that's one aspect of tax planning. There's other aspects, it's called the Augusta rule, where you can actually rent out to yourself from your business to yourself if you have a meeting at home. But all these rules do take requests, and they've tried to figure out there's different strategies for it. And not every business is different for every strategy.
Gotcha. And so I got to imagine then for the average person, this goes beyond just the filing of their individual or their business tax returns.
Right, and that's if you're waiting until the end, like when you're doing your taxes, about tax planning, it's already too late. Because all the tax planning, all the tax thinking has to be done in the year that occurred, due to the fact that most people are running things under a cash basis. So money coming in, you pay taxes, money leaving, you reduce your taxes. So it's all the tax planning has to be done within that year. If you worry about it like in March or April when your taxes are done, it's already too late.
Gotcha.
And the CPA guy you're dealing with is probably doing 200 returns, so he doesn't care.
Yep.
So the whole thing is you want to focus on that tax planning aspect within the year of your business.
Gotcha. And so when it comes to, you kind of mentioned some different formations of business, right? Whether I'm a solo entrepreneur, right? I'm a LLC or C Corp. How does that change? How's that different when it comes to those different entities for you?
It's extremely different, right? A solo prop is pretty much you receive a 1099 and you just fill it. It's probably, if you're going your business, it's the worst thing to do because it's the highest liability you're going to have.
Okay.
Then you got a single member LLC. And the thing is, that doesn't really affect your taxes. You do need to file Texas franchise tax when you have a single member LLC. But you don't need to worry about paying taxes on it unless your revenue, I can't remember, it was like over 1.8 million.
Okay.
If your revenue is that much, then you need to be paying franchise tax.
Okay.
But if it's lower than that, you just need to file. There's nothing major. So just, if you're going to create your business, create the single member LLC.
Okay.
Do not make your husband and wife on it, because that creates you a multi-member LLC, and then you're having an extra $600-$700 filing fee.
Okay.
It's a common mistake I get all the time. And the common mistake I had, this one client, like common mistake, husband and wife create company, yeah, but we didn't have any revenue, so we didn't file. Waited a year later, and then they found out they didn't file, so now they have a $5,000 fee.
Oh my goodness.
So it's a wrong structure, it's very important. Then is S Corp. An S Corp is the best thing to do if you are profitable around at least $70,000 to $80,000 profit. If you're under that, it's going to cause a lot more complications to do it. And this is a common mistake that I get a lot of new clients come in. They're like, hey, I'm an S Corp and I just started my new business. I'm like,
oh,
why did you do that? You put yourself on an extra cost of filing. You put yourself a lot more complexity, and you're not taking any benefit of the S Corp because you're not making a profit. You're at a loss. So it's the worst thing to do. So you can always do you create your company. You can always do a late election for converting over to an S Corp throughout the year. You just got to send out a form to the IRS and just fill it out. And then C Corp is also a mistake, because when you're under a C Corp, you're going to be double taxation. one part from the business, and then if you take money out of the business and go to yourself, it's also going to be taxed. So C corps are only really good if your net profit is around 600 to 700,000, and then you're not taking all that money and spending it on a boat or something.
Okay.
So like making 600,000, you're taking only 200 to 300,000 dollars personally. Then C corp. So it's every structure is very important because I'm assuming everybody's different.
And I got to imagine that for a lot of startup businesses, they might start in one organization, right, an LLC or a solo prop, but it sounds like that might be not the most advantageous, and they can make those changes as they grow.
Yes.
Okay.
I mean, I'm in a situation where somebody is an S corp, and I'm actually thinking about converting over to a C corp. And you can convert over to the C corp, but there's also complexities. You can't convert back to an S corp until 5 years. So they're like, oh, we're now at a loss. Like, well, we already converted. You thought so. It's always about the strategy, what's going to happen in the next couple of years.
Gotcha. So really planning ahead is a crucial element when it comes to these tax conversations.
Yes, and it's always a very focusing on that. It's like, okay, it's not, when you're thinking about taxes, when you file taxes, it's all about the past. It's already done, just like anything else. It's history, you can't change it. It is what it is. The future is flux. So tax planning is always about the fluctuation of things, right? Maybe you're doing really well this year. If you're in COVID time, you're selling PPE. That is going to be a huge sell in during COVID. Now it's sort of drifting off, so obviously your revenues are going to be the same. So it's always different on what you think your business is going to do in the next couple of years.
So I got to imagine you mentioned how there's different profit levels that I should maybe be looking at my structure.
Yes.
I got to imagine for businesses, this tax planning becomes more of an issue as I hit a certain size or certain milestones, right? So can you kind of explain to some folks what that looks like?
Sure, that's actually a good question, right? Normally, if you're hit around, I would say we need to start really thinking about tax planning around $70,000 to $80,000. If your net profit is $70,000 to $80,000, that's when you need to start thinking about tax planning. Then it just goes up from there. But if you're at, okay, I'm trying to figure out, I'm making $15,000 on net profit, you're going to pay some taxes. It's not that big of a deal. Just get it done. I mean, you take your home office deduction, you do some things here and there. But if you're on that $70,000 to $80,000, that's when you need to do it. We all have to pay our taxes. If you don't pay your taxes, it rings an alarm bell. So we all have to pay it. But do everything legally and figure out the right strategy to do it.
Now, if there's certain businesses that might not be profitable immediately, but I'm hiring a lot of staff. So I'm giving in some good revenue, but I'm taking all that revenue and I'm basically reinvesting it back into business in order to expand.
Right.
Is there a complexity there that you would say, you know what, that's when you should start looking at tax planning from that size perspective?
That is also true. That is more on when it comes to payroll, right?
Okay.
When you have payroll taxes and try to figure out, okay, are they a 1099? Because then you don't have to pay employment taxes. But that's also complexities that maybe they shouldn't be a tenant, maybe they'd be a W-2. So those questions do come involved as I try to figure out where categories. It's not much you can do when you're at a loss, but it's definitely a lot more when you're trying to figure it out. But on that aspect, when you have a bunch of employees and you're a business from 2019 and 2020 and 2020 when you continually do it, there's it's been gone out for a while now. It's called retention tax credit. And there you can get $7,000 per employee per quarter if your revenue reduced significantly from 2019 to 2020 and 2021.
Wow.
So there's a number of clients that I've got talking to, and they're getting a significant amount, basically almost the third time of PPP income in a way.
Yeah.
But they're getting a refund back. But there are complexities to it, and not everybody qualified because a lot of them have gross receipts and how much you're affected by COVID. So a lot of these comes in part of tax planning, especially with this retention tax credit, and people are getting quite a bit of money. And these things are done through the 941s, which is a payroll tax form.
Gotcha. So I got to imagine over the last year, a lot of businesses really, a magnifying glass was kind of exposing if they were truly ready to be able to do a PPP or even be able to, again, show forth some of these credits that they have all these employees.
Right. I mean, the PPP was a huge thing, and there was a lot of money, and it was really easy to get at the time, which is good and bad because there were some fraudulent transactions. We all heard the stories. Yep. But then there was also questions of there's the EDIL. Right, it was the Economic Disaster Injury Loan. People had $150,000, and then they increased $500,000, and now the SBA was going through a number of situations. They're understaffed, just like everybody else in the government, and that also came up complexities. Okay, the SBA is asking for this, okay, sending it out. So they're always asking for things. Now it's the retention tax credit, and that one is actually be a lot more money involved in it, but you have to do it correctly, or you're gonna get a tax bill because they may give you the money and then may come back 3 years later like, hey, you actually owe us $300,000. Yeah. So you want to make sure that is actually coming into the right categories.
That's amazing. So if people are realizing that they're, hey, some of the things that you talked about, I know my CPA firm, my bookkeeper is not bringing up these things to me, we might need a conversation. What's the best way for folks to get in touch with you, Ranjit?
You can give me a call on my cell phone. It's 713-258-0196. It's my business cell phone and I always keep it around me. So it's 713-258-0196. Also, you can check my website is at makh-accounting.com. Or you can also email me at Ranjit, R-A-N-G-I-T, at makh-accounting.com.
Wonderful. Well, I appreciate you coming on and just telling folks how they can start planning. And so really it sounds like any time is really a great time to have these conversations if you want to be able to make sure that you're doing some right strategies to reduce or to just make sure that you're doing the right things when it comes to a lot of things that are out there.
That's true.
Okay. All right, folks, we're going to take a quick commercial break and come back with a Zoom